Let's go to our viewer questions today. We've got a couple that's come directly for Roger. The first one comes from Jason. Jason asks Roger directly, when buying a company based on the intrinsic value you have calculated, would you buy at that value or do you require a further margin of safety? He also goes on to say, and if you require a further discount to the intrinsic value, does it change dependent on the company? For example, a small cap versus a blue cap, and is this discount subjective or do you follow a formula or rule to arrive at the margin of safety required?
It's a mouthful, isn't it? But clearly, what's that person's name?
Jason.
Jason. Clearly, Jason's done some work on this and thought about it. If I value a company at $5 and it's trading at $4.95, it's too close to call, really. If I felt that it was a great business, a top quality business, and it really, if ever, came into that value range, I would start purchasing some shares there, but I wouldn't load up on it. I wouldn't buy a lot. I'd hope to get a 15 to 20% discount if that was possible. Now, in terms of the second part of the question, blue chips versus small caps, do I look for a bigger discount? No, it's always about the same. I'm always looking for a 15 to 20% discount to intrinsic value to buy a lot of something, but I'll use a different required return on my valuation. So a larger company, a Woolworths, for example, or a Telstra, it's going to get a lower required return. So I might use a 12% required return to come up with my valuation. Whereas with a small cap, I might use a 15% or 16% required return.
Okay, speaking of the way you come up with your formulas, got one more question from a viewer, from Tom. Tom asking, I understand Roger follows the Warren Buffett rules of buying stocks with low debt and high return on equity. I look for debt to equity which is down or below 75% and return on equity above 10%. What criteria do you use?
Okay, the important thing is, I think these are great questions. I mean, this is the stuff I'm really passionate about, and I know that it works. It works really well. He's on the right track, but I want to look for a company that's got no debt. I'd rather a company have no debt or see that its debt is declining. JB Hi-Fi, for example, started off with a higher debt to equity ratio, but it's been falling substantially for a couple of years now. And that means their cash flow is very good, so they're able to pay that down. In terms of return on equity, I want a margin of safety. So I want a return on equity that's higher than my required return. So if I'm using a 15% required return, meaning I'm aiming to try and get 15% a year from my investment, then I want to find businesses that generate a return on equity that's more than that. There's one exception, and that is you can buy a business with a return on equity of 10%
right, if
you can buy it at a discount to equity, because then your return on equity on your purchase price is much higher.
Okay.
So they're on the right track, a little bit higher return on equity unless you can buy it at a discount to equity.
That sounds like a lot of numbers to me. Right?
No, it's really simple. 2 numbers, Richard, 2 numbers. No debt, lots of return on equity. You want to buy businesses with a lot of equity and a high return on equity and no debt. Really simple.
That's why there's people like you around, though, for the lazy ones like us. Roger, thank you very much for your time.
It's a pleasure, Richard.
Roger Montgomery from rogermontgomery.com.